Hey everybody, it's John King. It is Friday, July the 10th. Thank you for joining me for my weekly market update. So what are we going to talk about today? Well, this week, the Federal Reserve meeting minutes. I don't talk much about the minutes, but I want you to understand what that looks like. Every time the Federal Reserve meets, they're hush-hush on what they talk about for the first 2 days. They meet on a Tuesday and a Wednesday, and then Wednesday afternoon, they come out of their hole kind of like the Groundhog Day gopher, pokes his head out of the hole and just tells you what they're thinking. So the analogy probably didn't land very well, but I hope you know what I'm talking about. Anyway, the Fed comes out at 11 o'clock Pacific time and says, hey, this is what we're thinking, but you don't know what they actually talked about during the meeting. Only the Fed chairperson is able to speak at that time. But then a few weeks later, we get the meeting minutes, which is the complete detail of what we talked about. Well, this week we got the meeting minutes from the June meeting. And a couple of things. First of all, the Fed kind of said, hey, say less. Now, I never understood that comment. I heard it a couple of times recently. I'm like, what the heck does that mean? But the Fed is saying, in this case, a little different, we're going to say less. We're not going to tell you as much. Kevin Warsh, the new head of the Federal Reserve, chairman of the Federal Reserve, is basically saying, look, the prior chairman, the prior Federal Reserve chairman, they told you a lot about what they were thinking, and I don't know if that's good for the market. And I'm in charge of this joint now, and so I think we're going to tell you less about what's happening. I'm not sure how that's going to play out in the markets because we have traders, people who are exchanging bonds, which mortgages are a bond, freak out when they don't know what the Fed is thinking. And the Fed is now saying we're going to share less information. So we're going to have to play that by ear on how much information they're really going to release. And is that going to make us even more volatile or less? The Fed thinks it's going to make us less volatile because it's hard to read the tea leaves if there's no tea leaves to read. I worry it's going to make us more volatile because when you don't know what somebody's thinking, then your brain fills the gap. Okay, it's called a narrative gap. There's actually studies about this psychologically, that if there's a gap in what somebody says, then your brain rushes in and fills it. It's like if I literally stop talking right now, which I'm not going to, your brain will rush in and say, oh my gosh, did the video die? Is there a bad connection? What's going on? Literally, I just pause and stop talking. Now, I'm not going to do that because you will think that the video went dead and you might click off. But that's called filling a narrative gap. And the Fed's going to create more narrative gaps that people's brains are going to fill, and that might create more volatility, not less. Okay, so having said that, the one thing the Fed is clear about is that the people on the Federal Reserve are giving mixed signals on whether they think rates should go down or go up. What is clear is inflation is going to be the number one thing that they're looking at. They feel, and I kind of agree, the jobs market is stable right now. So we've had some ups and downs in the jobs report. Jobs report came out last week right before the 4th of July. It's stable, okay? So the Fed has two things they're worried about. They're worried about keeping people fully employed. Well, that's not fully employed, but they're doing pretty good in that regard, and controlling inflation. And inflation's taken off again. And the next inflation report comes out on Tuesday. So if you've got a loan right now that you're saying, hey, I'm not sure whether I should lock my loan or not, well, Tuesday is going to be another moment where we're reading tea leaves, where we're trying to figure out what's happening with interest rates based upon what's happening with inflation. And here's the biggest problem. Inflation is looking like it's going to get worse, not better, because the whole peace treaty in the Middle East appears, every day it's going to change, but it appears that it's off again. That this week we had conflict again between Iran and the United States, and Trump is at NATO summit and he says all bets are off, the peace treaty is out, maybe it's back on again by now, I don't know, I'm not watching it every minute. The truth is that's part of the volatility. We are going to continue to have volatility until all of this is resolved. Oil prices shot up this week. Why? Because oil now may not be moving again through the Strait of Hormuz, which is where a lot of oil goes or comes from. And so that's creating more market tension and uncertainty. And so really what it's going to be right now is it's about the market headlines. The markets are in headline mode, I should say, where they're paying attention to the headlines and reacting, which means one day we're going to go this way and another day we're going to go that way based upon what the headlines do. It's like driving while you're staring at your hood instead of looking out far ahead of you. Like, that's great. You're staring at your hood. You're not going to hit something, except you might run into something that you could have seen if you were looking a little bit higher. And right now, the market is just paying attention to what's happening right now, right in front of us, and not paying attention to where things are going longer term. And that can create a lot of volatility as you're swerving to go around something that you would have noticed if you would have been looking a little bit higher, but the market's not looking higher. They're paying attention to just what they're seeing in the headlines right now. So my advice If you like it, lock it. I don't know where markets are going to be. I've had many clients this week that we were locking interest rates, and every single one of them, I said, look, I don't know what tomorrow's going to bring, but we didn't know yesterday what was going to happen today, and now we know. We just don't know what's going to happen tomorrow. So if you like it, close your eyes, lock it, don't think twice about it, because you're not going to win. Either rates are going to go down and you're going to say, oh my gosh, I did the right thing, and now you want to get greedy. You're going to keep, not greedy, you won't think of it greed, but it is. And you say, well, that paid off, let's do it again. And then the only time you're going to actually want to lock is when rates go back up again. And then you're going to tell yourself, okay, I promise if it goes back to where we are at the lowest, I'm going to lock in then. It's a never ending cycle. You will never win. And so if you like it, lock it. All right. Last thing I want to talk about. Quick, how do I want to say this? Side jaunt. I want to talk about jumbo loans. What is a jumbo loan? That is actually a question that I've gotten a couple of times this week from clients who are saying, hey, John, I've heard of a jumbo loan, but I don't even know what it is. Why is it different? Why does it matter? And so I'm going to give you a quick 3-minute intro into jumbo loans. So a jumbo loan is a loan that is greater than the conventional limit for Fannie Mae and Freddie Mac loans. So those are called agency loans. Loans that are done with Fannie Mae and Freddie Mac are agency loans. If you're trying to borrow more money than the agency allows, then the government won't be backing your loan. You have to go to the private market. Now, the private market is often big banks. It is real estate investment trusts. It's insurance companies. It is regional banks that they're lending their money. And so most people say, well, gosh, if you're going to get a jumbo loan, you should go directly to the bank because that's who's lending you the money. Here's the truth. Banks often have more money to lend than they have sales that they can make through their front door. So I want you to think about this. If you are, I don't care if you're Bank of America, you only have so many mortgage loan officers and you only have so much capacity to get a certain number of loans sold or originated through your loan officers. And those banks often have higher goals of how much they want to lend than what their loan officers can lend. And it creates an environment where these banks say, well, we don't want to work with brokers. A broker is kind of the wild, wild west to some degree. They'll jump from one lender to another partway through and they're like, no, we want more stability. So we want to work with somebody that has control over their loan officers. And the loan officers have a skin in the game because they represent the company that they work for. My company, Cross Country Mortgage, is the largest retail mortgage company in the nation. There's only 2 companies larger than us, but they're larger because they accept loans from brokers. We're the biggest one that doesn't accept loans from brokers, which means we've got banks banging down our door, giving us access to their money. And so we are in the best position possible to give you the access to all of these loan programs, and the banks are giving us a sweet deal on passing along great interest rates to you. So if you are thinking, you know what, I need a jumbo loan and I should go to my bank. If you have like $10 million or $3 million or whatever on deposit with your bank, go to your bank for sure. Because as long as you're well qualified, they're going to give you a screaming deal because they want to keep your business and they're going to make less money on the mortgage because they're making all this money off of your other investments. But that's not the case for most of you. Most of you don't have that much money sitting on deposit with a bank. And so the bank isn't going to give you that good of a deal. But when you go to the bank, you're only getting one set of guidelines, the guidelines that belong to that bank. And if that bank says, no, we don't fit those guidelines, or they're going to limit you and say, oh, well, the most you can qualify for is this because of how their rules are written. I've got 22 different banks that are giving us access to their money, which means I can look at each one of them and look at the rules between them to figure out which one's going to work best for you. So it's just a quick idea of what a jumbo loan is. It is typically for loans greater than about $832,000 is the current conventional limit nationwide. And if you're looking at a loan amount larger than that, then you fit into the category of jumbo. We also call it non-agency loans. But I wanted to share that with you today. Aside from that, gang, that is about it. I really appreciate you listening. I really appreciate you joining me every single week. Please share this if you found it valuable. Like and subscribe to my channel. And I look forward to talking to you next week. Have an absolutely wonderful